Hey everyone, welcome to the deep dive. Raise your hand if you've ever been turned down for a loan before.
Oh, yeah.
Yeah, me too. It's pretty common actually. Banks, traditional lenders, they can be really quick to just say no,
Hmm.
especially if your, let's say, financial picture doesn't fit perfectly into their very specific little box.
Exactly. Their criteria can be quite rigid.
But here's the thing, getting that no, it really isn't the end of the road for you financially. Not at all.
Absolutely not.
So today we're going to do a deep dive. We're exploring like the whole landscape of financial options that open up when those traditional doors seem to slam shut. We'll look at where you should turn next and maybe more importantly, understand the kinds of models that make these alternatives work.
That's right. And understanding that bigger picture, that whole ecosystem of financial solutions, that's really key. It helps you navigate the challenge, especially when you feel, kind of overwhelmed by all the information out there
Or the lack of information sometimes.
or the lack of it. Yeah. We want to give you some frameworks, really,
Yeah.
to understand why these other options exist and how they actually operate differently from the big banks.
Okay, let's unpack this then. When we started prepping for this deep dive, one of the first things we asked was, well, why? Why do traditional lenders say no so often? What did our research tell us about those core reasons?
Yeah, it's quite interesting when you look at it. Traditional lenders, fundamentally, they operate from this very risk-averse standpoint. They rely heavily on what you could call a standardized financial fingerprint. They want predictability.
Right, they want to know they'll get their money back easily. Yeah.
Exactly. A clear path to recovery if things go south. So the source material we looked at points to a few key areas where that fingerprint might look, let's say, incomplete or risky to them.
Okay, like what?
Well, first, a low credit score. That
Mm.
signals maybe past struggles or just not having much credit history at all, thin file.
Mm-hmm.
Then there's limited or inconsistent income history, fake freelancers, gig workers.
Oh, yeah. Freelancers, I see you. It's tough.
It is, because it makes predicting consistent repayment harder for them. Then, too much existing debt.
Hmm.
That suggests you might already be stretched thin financially.
Makes sense.
And finally, no collateral.
Yeah.
Like a house or car to back the loan. That removes a big safety net for the lender.
So it really does feel like they have this one-size-fits-all financial box.
Pretty much.
And if you don't fit neatly inside, you're out. But crucially, a no from one lender doesn't mean no from all of them.
That's the core message, absolutely. It just means that specific model didn't work for you. It encourages you to think critically about different ways lending can actually happen.
Right. And this is where it gets, I think, really interesting because when the traditional banks shut the door, you definitely have other places to turn. Our research highlights like the three main types of alternatives worth looking into.
Okay.
First up, credit unions. Now, these aren't your giant shareholder-driven banks. They're different.
They're member-owned cooperatives.
Exactly. Member-owned. And that structure often means they can be, well, a bit more flexible.
Yeah, what's insightful about credit unions is how that member-centric model changes things. They often look beyond just the numbers. They might consider your character, your ties to the community, things like that, because they're focused on serving members, not just maximizing profit like a big bank might be. It's more relationship-based.
Okay, that makes sense. So, second option, online lenders.
A big category now.
Huge. And many of them have actually specialized in what some people call second chance loans, designed for folks maybe with bruised credit or not much credit history.
That's a key area. They often focus more on your current ability to repay rather than just looking backward at past mistakes.
And how do they do that differently?
Well, connecting this to the bigger picture, online lenders really show how risk assessment has evolved. They use tech, sometimes AI,
Okay.
to analyze way more data points.
Yeah.
Not just your FICO score. They might look at, utility payments, maybe your education, job stability, stuff like that.
Wow, so a much wider lens.
Exactly.
Yeah.
It creates a more holistic financial fingerprint. This lets them see creditworthiness, where traditional models might just see, well, risk.
Fascinating. Okay, and the third one.
Peer-to-peer lending, P2P.
Right, PCP. I've heard of this. It sounds kind of different. Real people fund your loan. Is that basically it?
That's the essence of it, yeah. It's an intriguing model because it cuts out the middleman, the traditional bank. Individual investors directly fund the loans through a platform.
Okay.
And P2P is a great example of financial innovation, really. The risk gets spread across lots of different investors, and crucially, these investors often have different appetites for risk.
Ah, so not just one institution's strict rules.
Precisely. This can open doors for borrowers who don't quite meet that single institutional standard. The platform connects people who need funds with people willing to provide them, often using their own, sometimes broader assessment criteria too.
So three really different approaches: credit unions, online lenders, P2P. When you're looking at these, what should you prioritize? What matters most?
Good question.
Our research suggests things like speed, how flexible the eligibility is, and transparency are key. You need to know what you're getting into.
Absolutely. Terms and conditions matter.
And with those criteria, speed, eligibility, transparency in mind, some sources we looked at highlight platforms designed specifically to connect borrowers with a network of lenders.
Right, the network model.
Yeah, lenders who might look beyond just that traditional score and, importantly, could potentially get you funds quickly.
Speed is often critical when you need a loan.
Definitely. For instance, one service mentioned in our sources that kind of embodies this approach is called 15M Finance. Their whole model seems geared towards bridging that gap for people who've maybe been turned down by banks.
Yeah.
They connect you to this wider network,
Okay.
and they talk about loans up to, I think, $50,000 flexible repayment terms, and specifically state that you don't need perfect credit, which is kind of the point, right?
That's the target audience, yes.
Right.
People who need that flexibility.
And the process sounds pretty straightforward. You go to their site, 15mfinance.org, fill out what they call a 2-minute form. And here's a key thing they emphasize: no hard credit check initially.
That's important. Can you explain that distinction?
Yeah, absolutely. So a hard credit check or inquiry happens when you formally apply for credit, and it can actually ding your credit score slightly for a short time.
Right.
But a soft check, which is often used for pre-qualification like on these network sites, that doesn't impact your score at all. It just gives them a preliminary look.
Good to clarify. So you fill out the form.
Right. You fill out the form, no hard check right away, and they say you can get matched with potential lenders almost instantly.
So it leverages that network quickly.
Seems like it. And if you're approved by a lender and accept the offer, they say funds could be in your account really fast, maybe even in as little as 24 hours.
Wow. Okay. And what's fascinating here, stepping back a bit, is how services using these network models, like the one you mentioned, directly tackle that gap left by the traditional banks. They've essentially built a system for the people who don't fit the old mold, connecting them with lenders who are willing to use a wider set of criteria.
Yeah, it seems very targeted.
It does. And it raises a bigger question, doesn't it?
Yeah.
How do we keep adapting our financial system so they genuinely serve everyone, not just the borrowers deemed perfect by, frankly, outdated metrics?
That's a huge question.
It is.
Yeah.
And just a practical note here. While these network services offer a potentially faster path to funding, it's always crucial for you, the listener, to really scrutinize the full terms if you get an offer.
Good point. Like what specifically?
Look closely at the interest rates, any origination fees, the repayment schedule. Make absolutely sure it's the right decision for your specific financial situation before you agree to anything. Speed is great, but suitability is paramount.
Excellent advice. Look, we know getting rejected for a loan, it sucks. It can feel like a real setback.
It definitely can.
But it truly doesn't define your financial future or your possibilities. You do have options. As we've kind of walked through today, there are these innovative models, different approaches out there designed to help.
And maybe to build on that for a final thought, consider the power that comes from understanding and strategically using all the financial pathways available to you. Not just the most obvious or traditional ones.
Okay.
Real financial resilience, real empowerment. It doesn't just come from having a perfect score or a standard 9-to-5 job history. It comes from knowing your options. It comes from understanding these different lending ideas, these different paradigms, and knowing how to access the right resources when you actually need them.
So knowledge is power here.
Absolutely. Hopefully this deep dive encourages you to explore, on your own, how these diverse financial models could potentially support your goals, your needs, personal or business, especially when you hit those inevitable bumps in the road. Don't just stop at the first no.